Ladies and gentlemen, thank you for standing by and welcome to the Scentre Group 2021 half-year results update. At this time, all participants are in listen-only mode. There will be a presentation followed by a question and answer session, at which time if you wish to queue for a question, please press 0 followed by the number 1 on your telephone. Please note that the conference is recorded today, Tuesday the 24th of August 2021 at 9 a.m. Australian Eastern Standard Time. I would now like to hand the conference over to your host today, Mr. Peter Allen. Thank you, sir. Please go ahead.
Good morning, everyone. Welcome to Scentre Group's half-year results briefing. I'm joined today on the call by our Chief Financial Officer, Elliott Rusanow. We have delivered strong operating performance, even with a number of government restrictions in place during the half. In locations less impacted by government lockdowns, we've seen trading conditions better than those experienced in the first half of 2019. Today's results are pleasing because they demonstrate the resilience of our platform and ability to generate cash flow, with operating profit up 28%. We've experienced a rapid rebound in visitation as soon as government restrictions are removed. This highlights the value of our strategic locations, with the majority of the population living in close proximity to a Westfield living centre. We are confident visitation will continue to rebound when restrictions are eased. Customers tell us that they want to be back in our centres because the products, services and experience we curate is an integral part of their lives. A desire to connect and a quick return to physical destinations is a trend we have also observed in international markets. Our business partners have experienced a strong rebound in sales. Annual sales through our platform to June were $23.4 billion. During the first half of 2021, total sales, excluding cinemas and travel operators, exceeded the first half of 2019. All Westfield living centres have remained open during the period, operating with COVID-safe protocols and in line with their latest health and government advice. We are facilitating community access to COVID-19 vaccinations across all of our Westfield centres. We remain open to working with providers to leverage our proximity to the majority of the population for these critical public health initiatives. I'm proud of our team, particularly how we have kept adapting to the conditions and changing regulations, keeping our centres open and safe for the communities we serve. I want to thank them for their contribution to these results. Our purpose has been constant since Scentre Group was established more than 7 years ago, creating extraordinary places, connecting and enriching communities. Our strategic objective, our plan, is that we will create the places more people choose to come more often for longer. We have an ambition to grow by leveraging the strength of our core business and becoming essential to people, communities and the businesses that interact with them. We want to be the first choice for where people spend their time outside of home and work. We will achieve this ambition by expanding and enhancing our platform, diversifying the businesses we engage with and continuing to invest in the customer experience we deliver in our destinations. We remain focused on our customer strategy. Notwithstanding the current disruption to our business due to government restrictions across a number of regions, we've continued to make significant progress on customer initiatives that create opportunities to expand and enhance the Westfield platform. After the successful launch of our membership program at Westfield Newmarket in 2019, we launched Westfield Plus in Australia last July. Membership is now more than 1.9 million, having increased by 1.4 million members since June of last year, with high levels of member engagement. Last year, we piloted aggregated click and collect to connect our business partners with customers during periods of government restrictions. We learned a lot from this initiative and have channeled these learnings into a new aggregated click and collect platform, which we will launch in the fourth quarter. Westfield Direct will extend the in-centre experience and enable our customers to have greater accessibility to our business partners, wherever they are, across multi-channels. Physical stores continue to provide an integral role in driving customer engagement and growth for our business partners. Demand for space across Westfield living centres remains strong, with the portfolio 98.5% leased at 30th of June 2021. The group completed 1,515 lease deals during the half, including 619 new merchants. Leasing spreads on these specialty deals were negative 8.7%, and average leasing capital on these deals equates to 8.1% of total rent. Our leading platform, expertise and focus on curating an offering that our customers want has delivered long-term growth. Since 2010, our portfolio has seen rent per square metre across our total area grow by 23% to $822 per square metre at 30th of June. Over the same period, the portfolio's total area has grown by 15% to 3.9 million square metres. We have welcomed 139 new brands to the portfolio. Deal activity has been strong with a number of first-to-market and first-to-portfolio deals. In New Zealand, first-to-market brands for our luxury precinct at Westfield Newmarket include Moncler, Saint Laurent, Balenciaga, Alexander McQueen, Burberry and Jimmy Choo. First-to-portfolio deal brands include the Melia Experience Centre at Westfield Doncaster and Style Runner, Rebecca Valance and All Kinds at Westfield Miranda. We continue to support SME retailers to mitigate the short-term cash flow impact on their businesses during the pandemic through appropriate rent deferral and support. We have a mutual interest in seeing them get through this tough period and succeed. Given this ongoing support, we are very disappointed we are being mandated by the Victorian and now New South Wales governments to abate rent, transferring value directly from one industry to another and from our security holders to retailers' shareholders. This is bad policy. The government should be providing support where warranted. It should be targeted to where the need is greatest, those SMEs with aggregate turnover of less than $5 million. Another major capital provider to these SME businesses, the banks, have not been mandated to forgive interest payments. We continue to look through the cycle and invest in the quality of our portfolio. Last year, we were appointed by Cbus Property to design and construct the residential and commercial tower on the site of the former David Jones menswear store on the corner of Market and Castlereagh Streets in Sydney. This project continues to progress well, with completion expected in 2023. We continue to implement initiatives that support our strategy to operate as a responsible, sustainable business. During the half, we released our 2020 Responsible Business Report and now outlined the progress we are making on the 4 pillars of our sustainable business framework. The group is committed to achieving net zero Scope 1 and 2 emissions by 2030 across our wholly owned portfolio. We have developed a pathway and transition plan which will see us achieve at least 50% of this target by 2025, and then annual increments of at least 10% until 2030. Our New Zealand portfolio will be powered by 100% renewable electricity from January 2022. I'll now hand over to Elliott to take you through the financial results.
Thanks, Peter. Operating profit for the 6 months to 30 June was $460 million or 8.88 cents per security. This is an increase of 28% over the first half of 2020. Funds from operations for the 6-month period was $463 million or 8.94 cents per security. In total, the group achieved gross operating cash inflows of $1.384 billion. Our net operating cash surplus after interest, overheads and tax grew by 113% compared to the first half of 2020 and was $488 million for the 6-month period. The group announced a distribution of $363 million or 7 cents per security for the first half of 2021. As a result, the group has retained approximately $100 million for the half. This is in addition to the $403 million retained during 2020. Operating and leasing capital was $48 million during the 6-month period. Included as an expense is an expected credit charge of $45 million relating to the financial impact of the COVID-19 pandemic on rental income during the 6-month period. This compares to $232 million charged that was booked in the first half of 2020. The charge has regard to the level of cash collections and the government restrictions experienced during the half year. Our results for this half do not include any reversal of prior period expected credit charge provisions. Trade debtors after the expected credit charge provision at 30 June is $121 million, a $72 million reduction from 31 December 2020. Approximately $33 million of this has already been collected in July and August of 2021. As detailed on slide 8, our cash rental collection levels for the half year were $1.2 billion. This represents an increase of 37% or $325 million compared to the first half of 2020 and is in line with the second half of 2020. Rental cash inflow for the July month was $167 million. Overheads for the first half were $40.4 million compared to the $41.9 million in the first half of 2020, reflecting overhead savings and efficiencies. During the half, the group repaid $1.2 billion of debt, and we currently hold $1.2 billion of cash on short-term deposit. The group continues to maintain elevated levels of available liquidity, a strategy we have implemented since the start of the pandemic in early 2020. Given the continued uncertainty, we believe it remains prudent to maintain these settings. The group currently has $5.7 billion of available liquidity, sufficient to cover all debt maturities to early 2024. The average net interest cost was approximately 4.8% for the half year. This includes the impact of maintaining this liquidity, the cash held on deposit, as well as the financing activity undertaken during 2020. Excluding the line fees on undrawn facilities, the average net interest cost for the 6-month period equated to 4.5%. As at 30 June, the group had hedging of our interest rate exposure of approximately 55%. This compares to the 71% hedge position at the start of the year. We have been deliberate in having our hedge position reduce as contracts mature in order to take advantage of the continued low interest rate environment. We will review our position over the coming months. We retain our A or equivalent credit ratings from S&P, Fitch and Moody's. During the period, all 3 rating agencies upgraded Scentre Group's outlook to stable. The statutory result was a profit of $400 million, which includes the unrealised non-cash increase in property valuations of $41 million. 53% of the portfolio was valued externally, with the same valuation principles applied to the carrying values for the remainder of the portfolio. The average capitalisation rate was 4.89% at June 2021, remaining unchanged from December 2020. We have provided on slide 30 details of the values by property. The book value of our asset portfolio does not include any value attribution for the cash flow we receive as property manager, either for our own share of the assets or for the share owned by third-party partners, which represents approximately $16 billion of assets under management. Our property management fees are based on a fixed percentage of revenue and rank in priority ahead of the owner's share of that asset's income. Additionally, our property management rights remain in perpetuity. On slide 19, we have detailed the income that we earn as property manager. Although we earn this on our own share, as well as our joint ventures partner share, it is deducted as an expense by the independent valuer when they value the asset. That income, capitalised at exactly the same cap rate as the particular asset to which it relates, equates to an aggregate of $3.27 billion that is not recorded on our balance sheet as an asset. The accounting stated net assets of the group was $3.64 per security at 30 June. It is $4.27 per security when the value of our property management income is included. Both amounts do not include any value for our brand, platform or other income generating activities such as development, design and construction. I'll now hand back to Peter to conclude.
Thanks, Elliot. The first 6 months have highlighted the fundamental strength and resilience of our business and its ability to rebound when restrictions ease. Whilst we are currently operating through a period of government restrictions in key markets, we are confident in the ability of our business to perform. The group continues to target a distribution of 14 cents per security for the year to 31 December 2021. This is based on the assumption that the current government restrictions substantially ease by the end of October 2021. We are well positioned to come out of this period strongly, supporting our customers and business partners and continuing to deliver long-term growth for our security holders. I'll now open the call for questions.
Thank you. If you wish to ask a question at this time, please press 0 followed by the number 1 on your telephone keypad and wait for your name to be announced. Again, that is 01. Your first question comes from the line of Simon Chan from Morgan Stanley. Your line is now open. Please go ahead.
Hi, good morning, Peter and Elliot. Just a few clarifications from me. Pete, 8.7% negative spreads you mentioned in your prepared remarks. Was that for new merchants or was that for overall every leasing deal that you did?
Yeah, good morning, Simon. Yes, it's across every leasing deal that we did. And just to give a bit of detail, it's pretty similar across new merchants as well as renewals. And renewals were about 70%, I suppose, of all deals that were done.
Yeah, that's fantastic. A more finance-related question, probably for Elliot. You mentioned July cash receipts was about $167 million, yet you also said that approximately $33 million of collection were from trade debtors, outstanding trade debtors. Is that right? And if that's right, then does that imply that you've actually only collected about 120 to 130 mil of July billings then?
No, the 33 I was referring to has been collected in July and August, so it's spread over the 2 months. The 167 is just a pure cash inflow for the month of July. So part of that will relate to a previous trade debtor, but as you know, we have been consistently reporting the actual cash we've collected rather than a percentage of a theoretical billing, because we think that gives the community a better sense of the actual cash that we're collecting as a business, and therefore our cash flow, surplus cash flow.
Yeah, makes sense. And hey, I appreciate all the NOI stuff is going fine, but can you guys give a comment about how your ancillary income has been impacted in the first half, like, you know, car parking, advertising, like how much of that, you know, how much have you been hurt in that department?
Yeah, Simon, as you can imagine, in terms of the ancillary income, that has certainly been impacted with the impact of the lockdowns at the centres. And as you would have seen in the charts, we have various lockdowns across the different states at different times. So where you see the majority of our portfolio, particularly with regards to New South Wales and Victoria with the lockdowns, we have been more impacted with car parking and with our brand-based media. What we are seeing, though, is that the numbers are certainly better than where they were in the first half of 2020. Okay, so in terms of the reduction, it's not as large as what it was in the first half of 2020. We also hope, in terms of that, we're coming out of this, as I said, and leading up to the key period of the Westfield week of offers in November, and as well as in the Christmas period. And so that's a very important time for us in terms of having our centres open.
Right. Can you quantify that for us, Peter? Like, have you been shortchanged 5 mil or shortchanged like 50 mil on that ancillary stuff, just so that we can put it in context?
I think, Simon, just as a rough guess, I think with our car parking as well as our media, you're probably in the order of maybe 15, 20 mil, something in that order.
Okay, that's clear. Thanks, guys.
Your next question comes from the line of Richard Jones from JP Morgan. Your line is now open. Please go ahead.
Oh, good morning, Peter and Elliot. Elliot, maybe just a question for you. Just in terms of, you called out the expected credit loss allowance of $44.5 million. Just looking at the accounts, just wondering what the amounts written off relating to COVID-19 of 56.8 million is. I mean, I think you said it's not a write back of previous provisions, and I assume it's not in the MPI. Is that what you're saying?
So there's, as you know, we provision and then we process. And so what you're seeing there is the actual process occur that gets booked through, but the provision is probably the more pertinent number because it's what we expect to actually process eventually. So if we go back to this time last year, 232 was the provision. We expect that if it hasn't already been fully processed, it will be processed as an expense. Similarly, with the 44.5, that most likely has not been processed as yet because it's relates mostly later in the period, and it's a timing issue that will be an actual expense eventually.
And the 56.8 is the amount of the 232 that's been processed.
Effectively.
Is that what you're saying?
Yeah, on top of what we have previously processed in previous periods.
Okay. Peter, maybe a question for you. Just interested, clearly in states where restrictions have been, or short burst, that there's obviously been a pretty strong rebound we've seen in visitation and sales. Just interested, perhaps with reference to Victoria, what the experience is when restrictions have been elongated, obviously with reference to what that might mean for Sydney coming out of restrictions later in the year, hopefully.
Well, I think if you see the visitation charts, which we put on slide 4 across the states for the first half of this year, that it's really important to highlight the fact that even with the prolonged lockdown in Victoria, certainly at the end of last year or during last year, that our visitation basically went up to where it was pre-COVID. And so we are very confident that our visitation will continue to rebound as soon as these restrictions ease. And we've seen that time and time again across whether that's Victoria, the smaller lockdowns that we've seen, as you say, the shorter ones in New Zealand, South Australia, West Australia and Queensland. But Victoria, I think, is a great case in terms of the second half of last year where it rebounded very strongly after the restrictions eased in October.
Okay, good one. And then just finally, just any change on your payout policy? I think sort of last year you were talking about retaining earnings to cover operating leasing Capex and also fund growth and reduce debt. Is that still kind of implied in the second half guidance?
Yeah, it is. And as I said, we're still striving towards achieving a 14-cent distribution for the full year. And you would have seen that in terms of the first half of this year, our earnings were certainly substantially above our distribution.
Thanks.
Thanks, Richard.
Your next question comes from the line of Sholto McConaughey from Jefferies. Your line is now open. Please go ahead.
Oh, hi, thanks for your time and for a good presentation. It's nice and sharp and quick. I just had a quick question. The guidance before was at least 14 cents. So given the run rate you achieved in the first half, if it wasn't for these lockdowns, it'd be fair to say that would have been exceeded?
Yes.
Okay, good. And then just on the 44.5 COVID-19 charge, what was waived and what was an expected credit loss? Do you have a split with that?
As we've said in previous times, what we've processed, we've booked. I think it's been disclosed over periods of time, but the effective amount that we provide for is what we expect to expense at some point in time in the future if it hasn't already been processed. So assume it's gone. It's gone.
Okay. Okay, so gone. Okay. And then just on the, I appreciate it's a very fluid. How much of your income do you think is covered under the codes of conduct in New South Wales and Victoria on an annualised basis? And how much can you net off against land tax in New South Wales or Vic?
Yeah, so in terms of our overall income, from Victoria and New South Wales, it's probably somewhere around, in total for the SME retailers, it's probably around 15%. And in terms of the benefit that we get from land tax, it's relatively small because the majority of the land tax we have to pass on back to the retailers.
Oh, okay.
So we get no benefit. Yeah.
Okay. And then just on I know you don't disclose cash collection, but if you look at your sort of run rate, you're sort of 96%, coming in the first half just on my calc. So if you look at July, that would have been a sort of 80%. Is that sort of about right? That sort of collection rate if you're on a normalised basis?
Well, as I said, I don't think we're looking at it on a percentage standpoint because it is obviously July is lower than the run rate that we've been disclosing. You can see the run rate's been pretty consistent around that $200 million mark, which were for the first 6 months, which was a very consistent run rate in the second 6 months of last year. So if we make now the assumption that 200 million is the new run rate, then you can base the 167 off that kind of 200 million normalised run rate.
Okay, and then just following up on Jonesy's question on the payout policy. Obviously, you retained 100 million this half. Obviously there'll be some arrears you'll collect in next year. If these lockdowns go to October, there'll be some laggards. Would you potentially use that to have a sort of a higher payout in the second half to maintain that 0.14, which is very welcomed in this environment?
As I said, we're targeting 0.14, and we believe that, with the restrictions easing by the end of October, that we'll be able to pay the 0.14.
Great. Thanks so much, and thanks for providing guidance.
Okay.
Thanks.
Thanks, Charlie.
Your next question is from Adrian Dark from Citigroup. Your line is now open. Please go ahead.
Good morning, Peter and Elliot. I think you made a comment in the worded results announcement, as well as in your prepared comments, about wanting to be the first choice for where people spend their time outside of home and work. I guess I think of that as being easier if you're doing fairly consistent and sizable development. Could you maybe talk about how you anticipate that will work in the environment where perhaps you might do less retail development going forward, or what your expectations would be if that is expected to ramp back up, please?
Yeah, certainly, Adrian. I think that you're right. Where we want to be is we want to be that first choice. So in effect, the third place outside of people's homes and work, that this is where people decide that they want to spend their time with us. Spending their time with us does not necessarily mean that we need to expand the portfolio of the size of the assets which we have. What we have been doing and has been ensuring that we curate the right mix to ensure that people are making a decision that they want to go, for example, to Westfield Bondi rather than Bondi Beach. And so what do we have to provide as far as the amenities, the activities, the engagement for customers to want to be at our place rather than other places. That does not necessarily mean they have to be there to buy goods or services or hairdressing or other items, experiences at each particular time. But what we want to do is we want to be that first choice. And so we're spending a lot of time in terms of the work which we're doing, particularly with the engagement with our Westfield Plus members, to understand what is driving them in terms of the reasons they want to be at our centres. What is the curated mix? And you would have seen that over the last 7 years that we've moved a long way from just selling stuff to also selling experiences. Some 43% of our space you have to experience on site, and whether that's leisure, entertainment, food, dining, health, wellness activities, it's really important that we're providing that because we're competing for people's time. I think the thing which was certainly highlighted is the fact that these lockdowns have highlighted how important our strategic locations are in terms of close proximity to the customer. Because we are seeing, certainly within those customer visit charts that we had on slide 4, that the customer wants to be there. We're just ensuring that we can retain that customer visitation, to increase that customer visitation. And whilst we have 20 million people in close proximity to our centres, we have an objective to be close to the whole 31 million people in Australia and New Zealand.
Thank you. Are you able to maybe confirm whether we should be expecting an increase in ambient style Capex?
I think when you look at our portfolio and the capital which we've spent, if I think back the last 20 years in terms of the portfolio in Australia, we've averaged something like $700 million of project starts each year in the portfolio. What we have seen, if you look through each of our portfolio, I think the ambience that we have in each of our centres, particularly with regards to what we spend our capital on, which is basically floors, vertical transportation, air conditioning and heating, as well as car parking, is pretty well up there in terms of what we have across the general portfolio. What we are seeing, though, is our retail partners and other business partners are investing capital into their stores, which is really improving the overall ambience of the place in terms of the facility which we're providing. And we're seeing that capital being invested and the benefit that the retailers are seeing by investing capital into their new stores and their fit-outs is a win-win situation for us, as well as the customers, as well as the retailers. So I don't see that we are going to be seeing an increase in ambience capital that's needed to be spent across our portfolio.
Okay. And then I'm looking at slide 9, the long-term growth in total rental income slide, which shows the growth between 2010 and the first half of 21. It looks like the portfolio's grown by 15%, call it 1.5% annualized over that time. Rent per square metre is up roughly 2% annualized over that period. It doesn't sound like the expectation is that the portfolio will expand significantly in square metre terms going forward. Are you anticipating that you can continue to increase rents on 2021 levels, or do you have any comments about, I suppose, the outlook for those two drivers, please?
Yeah, certainly. So I think that what we have seen is with regards to space, and the growth of that has come through not just through the development, but also through acquisition, and therefore our ability to be able to get closer to the customer and be in those key locations. And certainly we have an objective that if we could find other opportunities to invest in, to expand our overall portfolio, which is, as I said, 20 million of the 30 million people in Australia and New Zealand. So therefore the space will be the space. I think in terms of driving rents, really comes out in terms of driving customer visitation and becoming that third place. If people are wanting to spend their time, then our ability to be able to monetize that customer visitation is going to be all important to us. What we're seeing is that all of our leases have maintaining our occupancy. We're seeing that we've seen growth in terms of the contractual nature of the leases, in terms of rental growth across those leases. We're seeing strong demand by retailers and other businesses want to be where the customer is. And we're also able to get the benefit in terms of our ancillary income through our media, in terms of our screens, smart screens, as well as our car park revenue. So I see overall in terms of our portfolio, we have a strong ability to be able to grow the income that we receive out of that portfolio through increasing the customer visitation, the duration of time they spend with us, and getting more people to come to us. In some respects, it's a little bit like an analogy of a toll road. What we've seen is we've seen the road get extended. We're seeing more traffic on that road, and we're increasing the charges for the traffic to use that road. And I think that's a pretty good analogy in terms of looking at what that graph in that chart in slide 9 shows.
Thank you. And perhaps just one more following on from that. It sounds like you're keeping open-minded about potential acquisitions, if I understand correctly. Are you able to maybe comment on your level of appetite for some of the assets that might come available in the near term, and perhaps how acquisitions look versus a buyback, particularly given your comments around the value of the platform and the stock price, please?
Yeah, I think when you think about our business and our opportunity to be closer to more people, and therefore, as I said, there's 31 million people, I think, in Australia and New Zealand, then there's a number of locations where we're underrepresented. And certainly if you think about some of the sites which we've acquired, a number of years ago, Mount Atkinson in northern Melbourne is a site which will continue to grow. As you're aware, we bought into Westfield Direct in the end of 2019. So there's a number of areas where we are underrepresented, which gives us an opportunity to find those opportunities. It's going to be very, very dependent. In terms of all acquisitions, you need to have a willing seller as well as a willing buyer, and therefore it's a competitive market, because what we're certainly seeing is these really strong assets. And when you look at the traffic flows that we've had, when the restrictions ease, our business really strongly rebounds. And I see that this is what we're going to be seeing. And what we have is we've got a government now which is focused on the vaccination and therefore opening up the economy once everyone is vaccinated. And this is going to give, similar to what we're seeing in the US and the UK, consumer confidence to be able to get out and get about, which is exactly what people want. As a human being, as a social animal, we're seeing that people want to get out.
Thank you. That's all from me.
Thanks, Adrian.
Your next question is from the line of Grant McCasker from UBS. Your line is now open. Please go ahead.
Thank you. Just follow-on question. So where would you take your current gearing level to in the event of either capital management or an acquisition?
I think that's granted at this point in time, given that we're not seriously looking at anything at this point in time. It's something which we'd have to assess at that time. But we also, as you've seen, we've also got other capital sources in terms of how we can fund our business. And even when you think about the subordinated notes which we put in terms of tapping another market, I think that just highlights the flexibility that we have in funding. We're also, as you've seen, we're also retaining earnings as far as the business. One of the things we said last year as far as our distribution was the fact that we wanted to retain more earnings to facilitate growth in our business over the longer term.
Great, that's very clear. And just following on from a comment that Elliot made, you said you're reviewing the interest rate hedging position in coming months. Is that to say you'd put in more hedging, or you'd look to sort of restructure the existing positions?
I think it's probably more to do with taking advantage of how low for longer, how longer low looks like, and putting back on additional hedges at the appropriate time to lock in that lower for a longer period of time.
Okay, great. And then just one final one. The full year result, you highlighted potential increased investment in sort of platform technologies. You know, I guess you called out Westfield Direct. Are you able to highlight sort of how much you're spending and if you're expensing or capitalising that this year?
Yeah, so we're spending probably around 10 to 20 million $10 to $20 million in terms of that. We hope that we see that this is going to be an investment for the business rather than so therefore an asset, and so we're getting good value out of that.
Okay, excellent. Thank you.
Thanks, Grant.
Your next question is from the line of Stuart McLean from Macquarie. Your line is now open. Please go ahead.
Good morning. Thanks for your time. First question's just on lease structure. So those leasing spreads have come down -9%. They're getting pretty close to what they were pre-COVID at -6%. I was just wondering, kind of expectations for those leasing spreads and any change in lease structure as well, please.
Yes, Stuart. So there's been no change in lease structure. What we're seeing is we have a lease with a fixed base rent, contractual increases on typically an annual basis. What we are seeing though is that our partners are expecting leases to be a little bit longer. So we're seeing rather than a 5-year lease, there's probably 5 to 7 years on average, which is a good thing from our perspective. I think that gives the retailer the confidence in terms of amortising the capital they're going to invest in the stores to be able to amortise that over a longer period of time. So that's from a lease structure point of view. From a leasing spread, just so you be clear, and I say this every time, is that we're talking about apples and oranges. You know, the portfolio in terms of the leases that expired this year, which are being renewed, and we've got new retailers in, is very different than the one in the previous 6 months. And so that's why it's really important in terms of looking at the long-term growth in terms of our space and the long-term growth in rental income, because that smooths it out and shows the real performance of the organisation rather than just the day-to-day, you know, comparing apples and oranges.
So on a medium-term view, do you think it's the -8%, -10% the go forward, or can you get back to those kind of pre-COVID levels, closer to -5% or even better than that? How do you see that through the medium term?
Well, I think that the key answer to that question is that overall rent will grow, okay? But in terms of the makeup of that, it's going to be very dependent in terms of the particular store, the particular location at that store, the particular centre that store is, and the use that store has. Because what we're trying to do is curate the right mix, as I said to Adrian's question, to be able to drive customers into our centres so that we are that first choice outside of people's home and work. So curating that mix, there may be a cost for us in terms of being able to do that, but we know that over the longer term, that's going to be able to drive rental growth across the business and the portfolio.
Okay, thank you. And then my second question is just on cash flows. Looks like they're at $460 million, pretty much in line with FFI. There was a $72 million reduction in trade debtors. To marry those up, please, Elliot.
So you were just cutting out when you were asking that question. Am I repeating?
Apologies. Sorry. So I was just looking at the net operating cash flows for the GEO, so around $460 million. that's in line with FFO, but there was $70 million in trade debtors, or reduction in trade debtors by 72 mil. So just trying to line that up.
Yeah, it is difficult to line up because obviously we've had, as we said, an impact on other income flows, so car park in particular. And so in aggregate, and we've had an expected credit charge as well that we've booked in the result. So in pure cash terms, cash collected over the 6-month period was in excess of FFO by some $20-odd million, cash on cash. When you're now mixing it with accrual accounting, you will get some differentials because of the impact of the expected credit charge, the impact of car parking, the reduction in the trade debtor, and the surplus cash that we collected last year, the surplus cash that gets applied to a trade debtor for this current period, but how that flows through into the next period. So it's very difficult to look at distinct 6-month periods on the analysis that you're talking about. But I suppose the overall message is that our cash inflow is particularly strong.
Okay, thank you.
Thanks,
Your next question is from the line of James Druce from CLSA. Your line is now open. Please go ahead.
Yeah, good morning, Peter. Good morning, Elliot. Similar sort of cash question. It is getting a little bit confusing. Can you just provide a bit of a reconciliation, sort of trying to get back to almost 2019 cash flow? Because you're sort of doing 200 mil a month, so that's 2.4 bill. But if you look at 2019, you're doing, a bit over 3. You obviously had some asset sales then, and a few other further bits and pieces. But it just helps to get a sort of normalised view of where that cash collection should go to.
Yeah, the 3 billion you're referring to includes project development, design, and construction inflows, which obviously have a high expense margin to them. So, in terms of the actual rental inflow, I believe that we were running at around 210 million a month prior to COVID. That 200 million probably equates to that, like-for-like number. The other thing that you also have to take into account is that we have disposed of a number of assets, particularly an office building in Sydney, as well as the joint venturing of Burwood. But offline, we can provide the reconciliation to that. But effectively, you're comparing 210 to 200.
Yeah, and I think also the 1.2 is just rental income. It doesn't include the ancillary income that we're getting as well. And I think that we're showing the total cash was 1.4.
384, yeah.
Yep. No, that makes sense. Okay. And can you provide any more building blocks on just how we should be thinking about provisions for this half for the lockdowns? Was it too uncertain?
I think it's very early to provide that. Again, it all depends. It is effectively a look back when you think about it from an accounting standpoint. A code has been reintroduced in more recently in New South Wales and in Victoria. But given that it impacts, call it 15% odd of our tenants in New South Wales and Victoria, then it depends on how long it lasts for. It depends on the categories that they're allowed to open, when they're allowed to open. Depends when they're locked down. New South Wales locks down for a period of time. Victoria opens up and then locks down, and opens up and then locks down. So I think we'll have to assess it as we go through the period.
Yeah, and I think also at this point in time, the regulations, for example, of Victoria still haven't come out yet in terms of how it's supposed to work. So I think they're coming out today. Until we get the detail, it's very hard to predict.
Okay, and can you provide any colour on the cut between the lack of cash collected, I suppose, between SMEs and non-SMEs on that 167 number?
No, it's too early to delineate between that. I think we're talking about it very early in the month.
Okay, thank you.
Thanks, James.
There are no further questions at this time. We'll now hand back to Peter Allen. Please continue.
Yeah, thanks for joining us on our half-year call for June 2021. If you've got any further questions, please don't hesitate to contact our IR team. Have a great day, and I look forward to New South Wales and Victoria and ACT and New Zealand reopening. Okay, thank you. Bye.
That does conclude the conference for today. Thank you for your participation. You may all disconnect.